Hi, this is Ravi from the Nifty BN channel. In this video, we would be looking at a variation to the regular covered call option strategy, which can be used to achieve enhanced profits without much increase in risk. But before that, let me give a quick recap about the regular covered call option strategy. A covered call is a popular option strategy used to generate income from the stocks you already have in your portfolio, assuming you have shares equivalent to at least one lot size of the stocks. For example, if you wish to deploy the strategy on a stock you own, say Reliance Industries Limited, you should have at least 505 shares of RIL in your portfolio. Similarly, if you wish to do it on State Bank of India, you should have at least 3000 shares of SBIN in your portfolio. The covered call option strategy can also be applied to a futures contract of the same underlying asset. That is, it can be done on, say, a monthly futures contract of SBIN. In fact, a futures contract is less expensive when compared to owning the shares of the underlying asset, but it is always bound by an expiry date. The covered call option strategy involves selling an at the money or out of the money call option against either a futures contract or stock of the same underlying asset. Let us look at some pros and cons of this strategy. The advantages are it reduces the cost of purchase, as every time you sell the call option, you collect a premium, thereby reducing the initial cost of the stock or the futures contract. It increases chances of making a profit, as you make profit when the stock price stays the same, moves higher, or a little lower. The only time you lose is when the stock price moves lower significantly. The disadvantages are it offers no protection to the downside. That is, you are exposed to substantial downside risk should the stock price of the underlying plunge. There are instances when the stock price shrunk to as low as zero. It caps the upside profit potential. The strike price of the sold call decides the amount of profit you can make should the stock price of the underlying take off. Now let's see how this can be done with an example on SBIN June futures, which is currently trading at 155.80, and SBIN June 160 call, which is trading at 10. The covered call strategy can then be executed as follows. Sell one SBIN June 160 CE at 10, buy one SBIN June futures at 155.8. Now let's look at the risk graph of the regular covered call. From the risk graph, it is clear that the strategy offers no downside protection below the break-even point, which is at 145.8, and that the maximum profit is capped at Rs 42,600. Now let's look at some calculations to know how we arrived at these numbers. As this strategy offers no protection to the downside, the maximum loss at expiry is theoretically unlimited. The maximum profit at expiry, though, can be calculated as follows. Maximum profit is equal to premium received when the call is sold plus gain in the futures contract price capped at the sold call strike price, which comes to about Rs 42,600. The break-even point can be calculated as follows. Break-even point is equal to futures contract price minus sold call option price, which comes to about 145.8. Now it's time to look at a variation of the covered call option strategy, which, when done the right way, can earn you additional profits. This is accomplished by adding a bull call spread to the regular covered call. The bull call spread plus covered call trade can be executed as follows. Buy one SBIN June 150 call at 15, sell two SBIN June 160 calls at 10, buy one SBIN June futures at 155.8. From the risk graph of the bull call spread plus covered call trade, it is clear that the strategy offers no downside protection below the break-even point, which is at 150.4, and that the maximum profit is capped at Rs 57,600. Now let's look at some calculations to find out how we arrived at these numbers. Here too, the maximum loss at expiry is theoretically unlimited. The maximum profit at expiry though can be calculated as follows. Maximum profit is equal to premium received from the sold calls minus premium spent on the bought call plus spread plus gain in the futures contract price capped at the sold call strike price, which comes to about rupees 57,600. The break-even point is at 150.4. Let's look at some advantages and disadvantages of this strategy over the regular covered call strategy. The profit potential of the bull call spread plus covered call strategy is greater than that of the regular covered call, but the break-even point is usually higher. Hence, you would be giving up some downside protection. Also, similar to the regular covered call strategy, the profit potential of the bull call spread plus covered call strategy is capped at the sold call strike price. The bull call spread plus covered call strategy requires more margin, and also you may have to pay more commissions as number of derivatives involved are more. Let's look at some numbers. The premium received at the outset is more for the regular covered call. The maximum profit potential is more for the covered call plus bull call spread strategy, but the break-even point is higher. Both the strategies have an unlimited loss potential when the market falls and a capped profit potential. You are assumed to have a slight bullish bias when you opt for the covered call plus bull call spread option strategy, as you would experience the maximum profit when the underlying is close to or above the sold calls at expiry. Thank you for watching. Please post any questions you have in the comment section. Also, please don't forget to like the video and subscribe to the channel.